Our next guest has been saying a recession is likely on the horizon for some time now. Here in an exclusive Squawk Box interview, Starwood Capital Chairman and CEO Barry Sternlicht. I'm trying to remember the first time you thought rates were too high already. Was it over a year ago? Has it been a year yet? Probably.
No. I mean, yes, but no. Good morning. First, we got to give you your croissants. So
nice. That's so nice. Thank you. Thank you, Barry.
Look at you. Look at you. And I see you did it from the donut. You did it from the donut pub.
You know, I love Taco Bell too for next time.
Okay.
If you, Barry,
that's all the money we're going to have left is to buy Taco Bell.
Is there more to all this than meets the eye?
So let's do a 3-second history of where we were. So my criticism of the Fed was that we had too few goods on the shelves and too much money, and prices went up because consumers were loaded with the stimulus packages. Now the shelves are full, completely full, and the consumer's running out of money. So the economy was going to slow on its own. So him raising rates as fast as he did, as quickly as he did, was throwing kerosene on the fire. The economy was going to slow. What I missed, and I think a lot of people missed, was the scale of the Bidenomics packages. The $3 trillion, which includes the American Recovery Act, the $1 trillion from the infrastructure bill, the $500 billion from the Inflation Reduction Act, which really should be a climate act, and the $250 billion of the CHIPS Act. That money is actually getting spent, and it's distorting the market. So you're seeing private investment go down, and you're seeing public investment rise. It's not quite. So there's a tug of war now between Congress's spending and the Fed's effort to try to weaken the economy. So it is really. It's an interesting inflection point. I feel like he's really going to blow it. And you're seeing that reflected in the bond market because the biggest victim of him raising rates is him, the federal deficit, right?
Are we, the things that we're seeing that seem like the economy is still hanging in there, those are due to Keynesian stimulus? There's nothing structurally good about the economy right now.
The consumer, as J.P. Morgan will say, he'll run out of money in the first quarter of next year. He'll be back to pre-pandemic levels. So there are some good things going on in the economy. Obviously, the energy complex, the oil sector, the drilling, building LNG plants, construction of data centers, electrical EVs, batteries. The manufacturing sector looks pretty good. There is some onshoring going on, but the consumer is not so healthy. Don't be.
But the labor market still is.
So the labor market's fascinating. In 08, you lost 1 million construction jobs. A 500 basis point increase in rates, you'd think construction jobs would go away. Year to date, 130,000 construction jobs have been added.
That's a federal stimulus.
And on our board is the head of a construction company, a CEO of a construction company based in Dallas. Mm-hmm. And he says he's never been busier.
I can't drive on a road.
And he said, how could that be? He says, well, he says 70% of his projects are now public. Yeah. There's 34,000 projects being done in the infrastructure bill. They're actually putting the money out, 6 million, 8 million, and it's propping up the numbers. It's probably adding 50 basis points to GDP, just the infrastructure bill. So the money, I thought it would be typical government that they take 10 years to put the money out. They're actually putting it out. So he's got 70% public business and 30% private. 12 months ago, it would have reversed. And we would look for wages or labor to weaken in construction. We've stopped building. Private real estate guys are looking at projects they don't pencil. We're finishing what we have. That's the delay impact. But we're not starting new projects. And you see construction starts in logistics down 70% in warehouses.
But the government funding's not going away, right? The government spending's not going away.
No, but Powell would be far more effective. Instead of raising rates a quarter of a point, he needs to walk across the street and talk to Congress.
He says that every time. Nobody listens to him.
They approved, these wonderful five guys who are going to strike the government, they approved a $1.7 trillion fiscal budget. It's bigger than 2 pandemic years and the $1.3 trillion from 2019.
But it's $400 billion. Jay Powell can't do anything about that, right?
What?
Jay Powell can't do anything about that.
Yeah, but that's there's no bigger customer of the economy than the U.S. government, right? There's no company that's spending $1.7 trillion or has $3 trillion in the bank to go.
All Jay Powell can do is make it tougher for Congress to spend. He can't tell, and that's what he's doing.
Well, I think he's got to actually you had Janet Yellen on the other day, and you actually asked her about this. She goes, well, it's all paid for. Really? We have a $2 trillion deficit. What is she talking about? What's it paid for?
This year we have a
this year. Yeah, well, and it was 1.4. I want to put up a slide on this. Can I do that? So there's a slide on the deficit out of control. First slide. You'll see it right there. So the estimate was 1.4 trillion, and now it's 2 trillion. Now go to the next slide. Where did the $600 billion delta come from? Well, the delta, the first one that comes out to you is receipts. And I've also been saying this and people haven't paid attention. The change in receipts, because he's crushing capital gains, right? So the government's losing on two sides. They're paying more on interest expense and they're losing receipts. So 170 billion delta in receipts. Receipts are going down. And they're going to go down further. Two reasons. People aren't selling and values have gone down. In the complex of real estate, which is so large, whether it's homes or buildings, there's no capital gains. Other than 7 stocks, the stock market's not up.
We need the IRS in there just harassing people to get that back
So he's
up.
losing. He's getting hurt. He's losing receipts. Raising rates is hurting capital gains. The second one is interest payments. Go to the interest payments one for a second. Put it up for a second.
There it is, 146.
146 billion. He's keeping rates higher than they thought. Medicare, Medicaid skip. That's the pandemic. Oh, you got to go back. Go back
He's
one.
talking about the last guy, the second
slide, please.
Yeah,
that one. And the interesting one, Social Security, that's the 8% increase in inflation. That's linked to inflation, right? And the last one is he sold off the federal balance sheet, and they lost $91 billion of income because they sold the bonds. So that's $600 billion. Go to the next slide. This is going to get far worse. Is the next slide. Like, look at the actual interest expense. It's the dark blue bar, the little bar. And the red bar is actually what the government owns, 5 or 6 trillion of our own debt. So gross and net receipts. But look at the light blue bar. That's actually 5.5% on the actual balance of the 33 trillion. So the interest expense and the deficit is going to go from 2 to 3. That's Bill Ackman, to 2 to 2.5 to 3 trillion. And there's no end in sight. And Powell loses control.
Yeah, we had this conversation earlier. Is he forced to continue quantitative tightening, easing, go back to quantitative easing because nobody's going to be here to buy these bonds?
Well, we're not exactly pals with the Chinese who bought our treasuries before, and the Saudis were doing a good job of kicking them in the face, too. So who's going to buy this stuff? And you see $50 billion of 2 years this week.
But
right?
if that's the case,
at some point, there's too much paper and not enough buyers.
If they have to go back to QE and get rid of QT, if they are easing on that side of the ledger, can they still maintain higher rates? Or you think, and do they have to because of the inflation problem?
I think his answer, because you can have, now let's go to inflation, because it's the boogeyman. I heard Bill Ackman say 3.5%, 4%. It's not true, right? There's last two slides on the deck on inflation. So X rent, CPI is below 2%. It's the slide that says inflation is rather.
There it is.
So X rent inflation is less than 2%. It ticked up last month because of oil. But you can see that he has what he wants. Inflation is less than 2%. There's 2 caveats here. Go to the next slide. So this is without rent. And again, the orange is rent, and the blue is actual rent. That's the lag in the government data. So you can see that the rent component of CPI is headed to the floor. And if that happens, you will get that 2% magic number that nobody thinks you can get. 2 caveats. Gavin Newsom raised minimum wages yesterday to $20 for restaurant workers. He's actually going to have a bill to raise healthcare workers to $25 an hour. The UAW is on strike. Right. They're asking for 40% wage increases. The unions, it's funny because the Democrats, what's wrong with the Biden administration? Why is he so unpopular? It's inflation. That's what people say. It's the economy, dummy. It's the economy. People have less in their pocket. But now he's backing the unions who are forcing wages up, which is creating the inflation he has to kill. So he's on both sides of this thing.
And by the way, former President Trump was there the next day advocating for the same thing.
I know. Right.
So you're talking about no matter what. What does Jay Powell do other than hold rates high? Because he doesn't have other tools.
The point is the economy. He should just be patient. The Fed should stop because what they're injuring is the balance sheet of the United States. The economy is going too slow.